Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Marc Chandler. We're going to be looking ahead to next week, a central bank meeting, as well as some jobs data, and taking a more bigger picture look in terms of the markets into next year with a couple points that Marc thinks, and I have to agree with him, could be pretty key to telling us, giving us a little insight in these markets and a correction that could be coming. Marc is the managing partner at Bannockburn Global Forex, also editor of the Mark to Market website, which we will link to in the show notes. Marc, next week we have a central bank meeting and some U.S. economic data. Take us through what you think is important.
Sure. The Bank of Canada meets next week. I think there's no doubt that they're going to cut 25 basis points. This would be the third cut. And I think that the important thing to keep in mind is that it is one of several central banks that have already cut interest rates ahead of the Federal Reserve. And by front loading the rate cuts this year, it means the Bank of Canada probably will cut rates less than the US next year. And so the Bank of Canada meeting on Wednesday, that's the only central bank that meets only major central bank that meets next week. But the end of the week is going to also be important for Canada. They release their jobs data alongside the U.S. jobs data. Of course, the U.S. employment report really dominates how the markets respond. And I think this is sort of the underlying message here with the U.S. jobs data. I think the markets move to hurt most of the people most of the time. And what's really the pain trade? The pain trade right now, I think, is that people have gotten very ambitious, aggressive about how much the Fed's going to cut. There still is about a 1 in 3 chance the market's got priced in of a 50 basis point cut by the Federal Reserve. And that's primarily because we've had some weak employment data, but we know that the July jobs data that came out in early August was skewed to the downside because of a storm, basically, in the United States. And I look for, and this pain trade would be stronger jobs growth and an actual downtick in the unemployment rate for the first time in 4 months. So what's the median? The median in Bloomberg now is for 165,000 gain in U.S. jobs. The bulk of those are going to be in the private sector, about 150,000. So what's going to happen, I think, and this is why I think when we spoke last week, I've been anticipating this kind of number for the U.S. and thinking that the dollar was overdue for a bounce. We are getting that bounce, and only in the last few days, so it's been kind of frustrating earlier in the week, but there's some satisfaction here with the dollar the dollar rallying here at the end of the week. So the currencies like the euro and sterling making new lows for the week. And I think that this has more room to go. I think it's primarily technical in nature. The dollar had sold off so hard in the last several weeks. It just was like due for a bounce. The momentum indicators were terribly stretched. Bollinger Bands were violated. And I think, like I mentioned, I think that the market has gotten a little bit too aggressive on its Fed view. So I'm looking for the dollar to continue to bounce here. And it's also being helped by slightly higher U.S. interest rates. And the one call that I thought could materialize, I had more confidence in it perhaps than the others, was that the stock market would come off. And there we've really been going broadly sideways still. I haven't seen that sharp break, which at the end of last week seemed more likely than it's really materialized.
Well, Mark, when you think about the dollar getting the bounce because it was pretty oversold, you're thinking that's still short term. Maybe put it in context of how you're looking at the greenback in the medium term and also not just based on US fiscal policy, but also on the other global currencies and how they're acting.
Yeah, sure. So in the big picture, I think the dollar's big bull market that I'd say goes back to after the great financial crisis. So it's been more than a decade in the making. I think that's over. In fact, when I look at some measures of the dollar, like everybody's familiar with the dollar index, it looks to me like we peaked a while ago and we've settled into a range. And I look for that range to break out to the downside. So the actual high for the dollar index was in September 2022. 2 years ago, next month, the dollar index peaked. We moved into this broad trading range for the past year and a half, almost 2 years. And I look for that range to break out to the downside, and that really would require a break of that 100 level. And I think we'll do that probably next year as the Federal Reserve accelerates its easing, and I anticipate a weaker economy. So I think that the dollar index is going to be falling towards 95 or so by the end of next year.
Marc, does this tie in with some of those comments out there of the death of the dollar, another currency taking over, in a sense, the world's reserve currency?
I don't know. You know what? I kind of think that my whole career, people have been telling me this. I have a story from the New York Times from the late 70s making the same type of prediction about the demise of the dollar as a reserve asset. I just don't think it happens like people are thinking, partly because I don't really see a compelling alternative. So I would make a distinction between a dollar's cyclical downturn and its role in the world economy. And the story I like to tell is that the origins of the reason that the dollar got to this role I mean, it looks like it really began, a key part of it began in the Middle East, but not the way most people think with the petrodollar and that, but really it was the Suez Crisis. And the Suez Crisis, you'll recall that Britain and France and Israel invaded Egypt because the Egyptians, when they got their independence, nationalized the Suez Canal, which was really being owned by a French-British consortium. The U.S. didn't know about the invasion and was very upset by it for a number of geopolitical grounds. And the British were having trouble maintaining sterling within the Bretton Woods system, whereas you'll recall it's pegged to the dollar than pegged to gold. The British were looking for help in stabilizing the pound and were going to go to the IMF. Remember, we think about the IMF now bailing out emerging market countries, or really the creditors of emerging market countries. But at the time when the IMF was first launched, it was really aimed for current account imbalances among the large developed economies. In any event, the UK wanted to go to the IMF for a large package. US had a veto. US tells Britain that if it doesn't get right with the UN, which opposed the invasion of Egypt, that the US would not only veto the UK from getting an IMF package, but it would sell some British pounds that we had, sort of like turning the knife in the UK. And so how does this relate again to the role of the dollar? Well, the Russians, the Soviet Union, saw the way the US was treating its special ally and took dollars that were on deposit in the United States and put them into UK clearinghouses. Those UK clearinghouses began loaning those dollars out. That is the beginning of the euro dollar market. And so what happens is these days, it's a huge market. Foreign companies and foreign countries borrow the dollar because it's cheaper than borrowing their own currency oftentimes. And what happens then is the dollar is strong. It sort of is a force multiplier. It forces these countries and companies to buy the dollar in a rising market. As the dollar weakens, they will again renew the interest in borrowing dollars because it's cheaper than borrowing at home. And so it's sort of like that shampoo, rinse and repeat. And so I think that cycle remains. I don't think the Chinese currency can be used for this. It's not really accessible, too regulated. And Europe is used to some extent, but not nearly large to rival the dollar in this role. So bottom line here, cyclical downturn in the dollar, but don't confuse it with the demise of the dollar as a reserve asset or a de-dollarization. This is just part of the cycle, and we're now going to have the down part of a cycle after having the up cycle for the dollar for the last decade or so.
Yeah, good distinction there, and that the downside in the dollar doesn't mean the demise of the dollar, two different things. And if you're expecting the dollar to pull back next year, or even in the medium term, and on a longer trend, we kind of tie that in with interest rates. We tie that in with the expected cuts from the Fed, but also a lot of countries, like you were mentioning, Canada and Europe, also moving ahead with cuts. Do you think at this point, Marc, that a lot of these cuts have not only just been priced in, but that maybe the jubilation in the markets and the continued push higher is getting a little over its skis? Because historically, when you look at when central banks start cutting, especially when the Fed starts cutting, it's not really a positive for the markets in the medium to longer term. That markets usually correct. So how are you looking at the way the markets are positioned in relation to these Fed cuts?
Yeah, it's hard to really see how the market's positioned. I think that it seems to me to be true that the reason the Federal Reserve cuts interest rates is not because they're optimistic on the economic conditions. In fact, the Federal Reserve is going to change rates in September, not because of how the economy is in September. We know that there's lag effects with monetary policy. So to me, that means that the Federal Reserve is going to cut rates because the outlook 3, 6, 9 months from now is going to be diminishing. At the first few cuts, though, the Federal Reserve is going to try to frame it, I think, as not really easing policy. After all, it's not at the inflation target. Instead, they're going to suggest that the level of restriction was first imposed in July 2023 when they feared the economy was overheating. That's no longer the case. And so the first few rate cuts are going to be removing some restriction. It's still not going to get easy policy. And then again, remember the lag effect. So even from the time the Fed first cuts rates, the time it affects the economy could be several months. So in the broad picture, then, I think everybody's caught up with AI these days. And I think AI ultimately is just pattern recognition. And I'm looking at patterns too. I think that one pattern is the U.S. economy typically does not have a recession in the fourth year of a presidential election year. And that's really what we're in right now. And while there are signs the U.S. economy is slowing down, the quality of the growth seems to be suffering a bit. I don't think that we have the data to say that we're in a recession yet. The economy still looks like it's growing above trend. And by trend growth, I mean about 1.7, 1.8%, which the Federal Reserve says is sort of neutral for inflation. So I think that the other pattern is the stock market typically doesn't fall in the presidential election year either. But the pattern is for the more difficult time to take place in the first part of the next term. And so I see that lining up with the slowing of the U.S. economy. And what we were talking about a little bit off mic was about the U.S. yield curve. And the idea is that the yield curve has been inverted for, I think, almost a record period of time here, but it's just about to be positively sloped again. And by positively sloped, I mean that right now the 10-year yield is about, well, I should say it's less than 2 basis points below the 2-year yield. And as that crosses, as the curve goes back positively sloped, that is like a shock for investors, for businesses. So the uninversion of the curve, if you will, that seems to be also consistent with an economic slowdown and a recession.
Marc, another comment on what the Fed is doing here. Look, we're going to be getting rate cuts, but the whole question is this QE? Is it an unwinding of quantitative tightening? We look at the Fed's balance sheet, and that has been heading down after a massive spike during COVID and even after COVID, peaked April 2022 and has been coming lower. I know the Fed's going to slow down on some of this balance sheet unwind, but how do you now group in Fed rate cuts that are coming with this balance sheet unwind? How do you classify it all?
Yeah, I think it's kind of funny. People like, even like policymakers like former central bank chair Bernanke, and I've seen other people use this idea too, that they don't fully understand how QE works in theory, but they see it working in practice. On the other hand, they're not really sure about QT. And we don't have a lot of experience with it. So I think I really put the QT on the side. And I put it on the side partly because frankly, I don't fully understand how the implication really works. And I've seen other countries who have, like in Japan's case, where they were reducing their QE, they were reducing their bond buying, but the markets didn't respond to it. And most recently, they've begun QT themselves. That is allowing more assets to mature and not replacing them. And so they've, in effect, begun shrinking their balance sheet. And I don't see this as being a market factor. So I try to leave the QT and the theoretical questions about its implications to the side. I think that the most important part of it is what policymakers say they think they're trying to do. And whether in Japan's case, they're not saying that this is supposed to be tightening monetary policy. So I don't think the market takes it as a tightening signal. When it comes to the Fed policy, though, I think that the Fed is going to continue the QT while it reduces interest rates. And I would imagine that it's going to run maybe through the first quarter of next year. And then by that time, the reserves are going to be probably at the level that they're comfortable with. Ample reserve system. But when you look at the Fed funds, when you try to, well, I kind of think that real issue is like we saw on the way up. What's the terminal rate? We were all trying to like fish for where's the top of the Fed funds going to be? And now I think people are doing the opposite. What's the bottom going to be? And right now it looks like the market feels comfortable with Fed funds bottoming close to 3%, either late in either I should say early 2026 or later in 2026. We have a better part of 2 years of Fed easing ahead of us.
Mark, just one tie in with this real quick. The bond market obviously relates to the interest rates in a big way. We've had seen bonds being bought lately. That's good. But in a economic contraction, and if the markets do roll over in the medium term, do you think people will flood back into bonds as a safe haven? Because they were selling off the last couple of years right along with equities, actually faster than equities, and not really providing that safe haven role. And if bonds did sell off, would the Fed do QE again? Would they go in and backstop the bond market and start buying bonds? How do you look at that in the medium term if there was some market contagion and some correction and the economy does slow down?
Oh yeah, I'm not sure that the Federal Reserve buys bonds because yields are rising. I think they come in to buy bonds in a couple of cases that they've done so in order to offset either negative, either like you're at the zero bound, that is, you brought Fed funds to zero, or there's financial instability, like the way the UK did in 2022. Financial instability that threatens the system, so systemic threat, and you come in and you buy bonds. I'm not sure when we look at the playbook and the tools that central bankers have, if a QE has the widespread appeal going forward. It poses problems afterwards, as we see now with the central banks experiencing unrealized losses, having bought bonds at, at very low yields, and how this disrupts as well the transfer of payments from the central bank to whatever the Treasury or the Finance Ministry in various countries. So I'm not sure what to make out of QE. I just don't think it happens just because interest rates rise. That's part of the price discovery and part of the self-regulating aspects that many people see in the markets. I am concerned, though, that there's this idea that because the U.S. deficit is so large, and by so large I mean 6.5% plus. I think Fitch has even a higher number for that, their estimate, but call it 6.5%. Not just last year or this year, but also next year's budget is sort of baked in the cake as well. And I think that the problem people have is they say, well, isn't this a debt crisis? And I think that with the U.S. 10-year yield below 4%, we have above 2% inflation, I hardly think that this is a sign that the market is having a panic or a crisis about the size of the U.S. debt or deficit. I think there might be other reasons to address the issue. And what concerns me is if I'm right and the U.S. does move into recession, will we have the political will to provide fiscal stimulus when we already begin with such a large deficit? So to me, it's really a question of prudence more than some kind of ideological disfavor for deficits or the belief that somehow the bond market is still not able to absorb the supply the U.S. is providing. So we were talking about this too a bit before that. I kind of think there's lots of ways to lose money, and I find new ways myself. But there seems to be only three ways people can make money in the market. They either go with the trend, and that is the momentum type. So if you, for example, you think that yields are falling, it means to be long U.S. bonds and going with that trend. But there's also another way to make money, and people do it by going against the trend. That's a mean reversion. That's looking for like what I'm saying, what's going to happen with the dollar. The dollar fell sharply for most of August, and I'm looking for this bounce, going against the trend. Those are the two basic ways. And the third way, which has come sort of back into play recently or more attention recently, and that's some kind of interest rate type arbitrage, the carry trade. You borrow the yen or the Swiss franc at low yields, and you buy something with a higher yield like U.S. Treasuries or maybe a more volatile instrument like S&P 500. And so I think when it comes to the bonds, like with the dollar, I do think there are trends. And I think that the trend in U.S. yields is going to be lower despite the larger deficit. And I'm looking at, if you think that the Fed funds are going to go to 3%, say by late 2026, then the 2-year yield, you should imagine, is going to go close to 3%. And we're just below 4% now. And if you tell me that the overnight rate is going to go to 3%, I'd say 4% for the 10-year bond is probably a bit much. And so if you told me the 10-year bond might go to 3.5%, that seems more reasonable. And so I like bonds. I think that when you think about how much risk there is in the stock market, bonds can offer, for some types of investors, a place to lock in a decent return. It's not that rule of seven, getting 7% for 10 years, you can double your money. I'm talking about getting a little bit less than 4%, but taking very little counterparty risk.
All right, Mark. We'll wrap it up here. Again, Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Click that link in the show notes to keep up to date on pretty much a daily basis with Mark as he breaks down currency moves, market moves, and key global economic data. Mark, it's great having you on the show. Thank you very much again for your time today.
Good luck. Thank you.